So here we have Christopher Vecchio, strategist at DailyFX, who is going to talk about trading opportunities using FX when commodity prices move. Chris, it is all you. Have at it.
Thank you so much, Todd. Thank you everyone for tuning in today. It's a beautiful last day of summer, I suppose, but now markets are finally starting to pick up. If you had the pleasure of joining myself and Todd last Thursday at the Nadex crash course talking about volatility, hopefully some of those lessons have proved effective in helping you navigate what's been a few days of tumultuous markets here. But if you did not, I would suggest that you reach out to Todd or the Nadex customer service team in order to get a copy of that presentation. Of course, we will be holding future events like that in the future. For those that didn't join, my name is Christopher Vecchio. I'm the senior strategist with DailyFX provided by IG Group. We are a sister company of Nadex. A little background on myself. I've been with DailyFX and the IG family for over a decade now. Started off as an intern back in 2008 and got to witness the market crash, which was quite a baptism back then. But in the interim period, I've since garnered a few degrees in macroeconomics and political science. I've been a CFA charter holder since 2017. I've also lectured at Duke Law School on derivatives trading. And so today I'm hoping to share some of the knowledge that I've learned over the years about how different asset classes, in particular, how commodities can impact FX markets and how we can use those commodity price movements in finding trading opportunities using FX. Of course, before we get our presentation started, I do have the standard risk disclaimers here just to share quickly across the screen. As always, any opinion I present is mine and mine alone, does not constitute trade advice on behalf of DailyFX, IG Group, or Nadex, so please keep that in mind. If you do have any comments or questions, feel free to put them in the chat box at any point in time. If you're looking for any specific insight as it pertains to what's happening in the market, would like to know your entry, stop, and time frame, that's where you've gotten into the market, where your risk lies, and of course, what your point of view is. I myself, I'm a little bit of a longer term swing trader. So if you are, say, a scalper, help me help you by providing as much detail or color to your information as possible. So with that said, I would like to just start off with a quick refresher course here on Forex trading. You know, Forex is traded in pairs. Unlike looking at a stock quote or a bond yield, Forex is all about relativity. It's all about ratios. I mean, you could actually see it in the euro dollar quote itself. You see euro divided by dollar here, euro being the base or primary currency. We're saying that it is worth $1.1765 US dollars, and the US dollar here is the quote or secondary currency. So when someone says that they are long euro dollar, it means that they are buying the euro and selling the dollar. They are looking for the euro to gain value at the expense of the US dollar. Now, in the FX world, there is what's known as a daily overnight interest rate adjustment, which is the next day rate for tomorrow. You may have heard about this in some similar forms of fashion with settlement prices. This was actually in the news with the T+2 settlement episode around Robinhood. You can learn more about that elsewhere, of course. But the point is that FX is highly contingent upon what's happening in rates markets. Now, rates markets are impacted by a whole slew of factors, but one of those factors would be commodity prices. And there's actually a strong link to this. Before we get to that link, however, I would like to remind people that you can also quote different types of assets in different currency denominations. So when we talk about XAU USD, we're talking about gold in dollar terms. We could theoretically talk about XAU JPY or XAG EUR, which would be silver in euro terms. For the sake of this conversation today, we'll specifically be referencing gold in dollar terms as our base pair, but you can always go over to your charts and look for different combinations, and you'll see that gold might move a little bit differently in terms of euro or pound or Canadian dollar. But there is a rational underpinning to all of this. There is a reason why we look to commodity prices to influence FX. And it's something that the Bank of International Settlements, what we refer to in the industry as the central bank among central banks, that the walk is not random. Now, some of you out there may have come across the book, A Random Walk Down Wall Street. You may have come across the follow-up counter-argument, A Non-Random Walk Down Wall Street. Both are seminal readings. I would highly recommend that if you can go to your local library or hop online to whatever bookstore conglomerate that you buy all your other products from, they may have copies of these books as well. And they're fascinating reads about how markets evolve and change over time. But the BIS a few years ago shared a study, and this study was rather informative, actually almost common sense, if you will, suggesting that there is a distinct commodity-related driver of FX movements. And this is not just something that happens out of the blue. It actually happens quite frequently. There is a link between commodity prices and exchange rates that's not driven by, say, risk appetite or even carry trade considerations. It's specific to the actual fundamentals, the actual economics of individual countries. To delve into this a little bit further here for a second, what this study suggested was that by looking at different commodities, we can actually see that higher commodity prices lead to an increased supply of foreign exchange in the markets of commodity exporters. And as a result of these increased export revenues, there tends to be an appreciation in the domestic currency. So in the medium to long run, this effect might be compounded by ensuing foreign direct investment as a result of more attractive investment prospects in the local commodity sector. And so when we're talking about what's happening in different currencies as they pertain to commodities, it's important for us to look into individual currencies, or rather countries' exports, to see which commodities are having the most significant impact or even most significant weighting. For Australia here, for example, in this chart, commodities make up nearly 80% of the country's total exports. And so when we're talking about the Australian dollar, there are a number of commodities that we look to in order to gauge which way the Australian dollar may be moving. In part, some of the big ones could be iron ore, which represents about 23% the share of commodity exports. We could even be talking about gold, which is about 8% of their total commodity exports. But it's not just iron ore, it's not just gold, it's not just the metals. We're also talking about energy here. Well, petroleum, natural gas together, these make up about 10% the total share of commodity exports from Australia. We're actually going to talk about that more in a little bit when we look at a specific Australian dollar cross and crude oil prices. But it's not just one of these major currencies like the Australian dollar, although the Canadian dollar likewise has a very high level of commodity exports relative to its total exports, just above 45%. And one may envision fairly easily, given the things that you hear in the news, that oil and gas and energy products, they tend to be a significant part of the picture for Canada. Now, petroleum oils, crude, that's 27% of total commodity exports out of Canada. Natural gas, a little bit over 10%. Petroleum products, refined, those are roughly just under 8%. If you actually want to take a step back and look at the entire Canadian economy, roughly 11% of Canadian GDP is tied to economic activity related specifically to the energy sector. So these major currencies like the Australian dollar, the Canadian dollar, whenever we see movement in things like iron ore or coal or gold or crude oil prices, there tends to be a knock-on effect in the world of FX. Now, I did mention that it's not just these major currencies. There are some more minor currencies, emerging market currencies that have similar levels of impact. For example, the Brazilian real here, 63% of its economy's total exports are related to commodities. And as one could see, iron ore is a rather large component of that, about 17%. Crude oil, petroleum, we're talking about another 10%. but also for the Brazilian economy, we have a lot of agriculture products, oilseed, sugar, coffee. And so there's no one size fit all rule here. You really need to drill into different economies and their various exports in order to learn which commodities could be impacting those specific prices. Now, not everyone likes to trade the Australian dollar or the Brazilian real or the Canadian dollar. And so for the sake of this conversation, we do have a few more charts to share, a few more countries and their exports. So if you are looking into foreign exchange markets, looking to find various factors that could be, say, influencing the Colombian peso or the Chilean peso, here are some other influences. For Chile, 85% of their commodity exports out of total exports, well, 40% of that's copper. Another 23% is basically copper ores. And so as you can imagine right now, as you look to your current charts for today, if you were to pull up your copper prices, the Chilean peso has not been faring well, in part because copper prices have been slumping. And that brings us back to what this study from the BIS revealed. In the short run, higher commodity prices lead to an increase of foreign exchange in the markets of commodity exporters as a result of increased export revenues. So the exact opposite is true as well. Lower commodity prices lead to a decreased supply of foreign exchange in the markets of commodity exporters as a result of decreased export revenues. And so if we see that higher commodity prices can lead into an appreciation of the domestic currency, then lower commodity prices can lead to a depreciation of the domestic currency. And I do want to point out here, as we're making our way through these various tables, that this is not simply just a one-way street. Now, for example, while Australia or Canada or Norway would benefit from higher crude oil prices, there are countries that are significant importers of these commodities that tend to benefit when those commodity prices decline. One such country is Japan. After the Fukushima earthquake in 2011 that took their nuclear power reactor offline, leading to the unfortunate radiation leak, up to 97% of the country's energy was imported. And so when you have higher oil prices, a country like Japan is tending to spend more money on what it imports, which means there's less yen in circulation. So higher oil prices, while good, say, for a currency like the Mexican peso or the Norwegian krone, we're talking about the exact opposite for a country like Japan. Japan imports a lot of oil, so higher oil prices tend to be bad for the yen, whereas, well, for the Mexican peso, higher oil prices tend to be good for the peso. Another country that fits to this mold, believe it or not, is China. China is the world's largest energy consumer and imports more crude oil than anyone else. And so when you see strength in oil prices, you actually tend to see weakness in the Chinese yuan. And we're going to get there very quickly here. But for the sake of today's conversation, we're really focusing on gold, we're focusing on oil and the various currencies that they may be impacting, the Mexican peso, Norway, Peru, all significant players in this realm, but so too are countries like Russia and South Africa. South Africa exports a lot of different types of metals, if they're base metals, if they're precious metals. Russia, a big country for oil exporters. I like to joke that Russia itself is basically Europe's gas station. It has an economy the size of Italy's, and it is responsible for most of the energy supplies that go to Europe. In fact, between petroleum crude and petroleum products, you're talking about a 60% plus share of total commodity exports for a country that sees over 80% of its commodity exports as a percent of its total export figure. So overall, when you're going through data, when you're looking at reports trying to figure out, am I interested in copper? Am I interested in crude oil? Am I interested in iron ore? We want to find countries that have significant ties to those export levels So for example, like I said for copper before, Chile, a great example, they export a significant amount of copper. Copper is a significant amount of their total exports. And so if you're looking for a proxy to trade copper in the FX market, you may look at the Chilean peso. If you're looking at oil, you may look at the Russian ruble. But there are specific relationships that come into play over the course of any given trading period, over the course of a year. Like I said before, we want to focus on the relationships between FX and oil here. And as mentioned before, the Canadian dollar is right up there. Why is this? Because the Canadian economy relies so much on oil. 11% of the total economy is based around the energy sector. Canada itself is the fourth largest oil producer in the world. And in exporting its millions upon millions of barrels a day to the United States, it actually constitutes roughly 49% of all the oil that the US imports. So here's a way to think about this. Going back to the BIS study earlier, and we're talking about the link for higher commodity prices leading to an appreciation of the domestic currency. If oil prices are going up and US importers need to settle their bills for the oil that they've imported out of Canada, it means they need to convert more dollars, more US dollars, into Canadian dollars in order to settle those bills. And so there is a sound, logical, fundamental link here between oil prices and the Canadian dollar. Now, why would you want to trade dollar CAD as opposed to just straight oil futures or an oil ETF? Well, there is an interest rate funding adjustment that takes place every single day in the FX market. And historically speaking, the Canadian dollar tends to garner a higher interest rate than its US dollar counterpart. And therefore, if you're looking to get long oil exposure, doing so via a short dollar CAD position may be something that's appealing. We've seen this relationship play out significantly over the course of the past year plus actually, thinking about what's been happening around the pandemic. What we have here in the bottom portion of the screen, the correlation between crude oil prices and the Canadian dollar, and you could see at various points throughout the past year plus, we've approached a near +1 correlation here. The orange line is the percent change in oil prices. The blue line is the percent change in dollar CAD. Ultimately, when we're considering what's been happening here, when we've seen higher oil prices, it has flowed through into a typical situation for a stronger Canadian dollar. And I would just say, given where things stand right now, I'm of the mindset that this relationship may begin to strengthen once more. Why might that be the case? Well, if we consider what's been going on in Canada domestically, they just had federal elections yesterday. Now, I'm not saying this is in favor of the current regime, Justin Trudeau, but the fact of the matter is that politics, when they seep into financial markets, they tend to represent a cause for change. And whenever change is possible, whenever there could be a change in economic policy, a change in monetary policy, relationships tend to weaken across asset classes because investors, they don't necessarily like using proxies given this exogenous interference. So now that the Canadian elections are over and the previous regime will stay in power, it may be the case that political speculation will subside. And if oil prices continue their trek higher, or conversely, begin to pull back more significantly because of some of these concerns that we've had out of China, the Canadian dollar will prove more sensitive to oil price movement now that it no longer has this interference in play from the political side of things. I mentioned before that we were going to talk about an Australian dollar cross, and that brings us to one pair that you may not look at that frequently, which is Aussie Yuan. Now, China is a producer of global oil supply, and it produces about 5% of the world's oil, but it ranks, depending upon which data feed you're looking at, either number 2 or number 1 in consumption, but it is the world's largest importer of oil overall. Now, while Australia is a large consumer of oil and petroleum products itself, the fact of the matter is that it tends to have a little bit more sensitivity on the other side of the equation. What I mean by that is when oil prices go up, Australia tends to see the Australian dollar rise. Now, I've mentioned this 3 or 4 times already, but I want to touch on it once more, going back to that BIS study. In the short run, higher commodity prices lead to an increased supply of foreign exchange in the markets of commodity exporters as a result of increased export revenues, causing an appreciation of the domestic currency. Let's flip that a little bit here to talk about China. Higher commodity prices lead to a decreased supply of foreign exchange in the markets of commodity importers. China is importing a lot of oil. When oil prices go up, it tends to be bad for the Chinese yuan. And so what does that mean for our Aussie Yuan relationship? Well, when we see oil prices, the orange line, increase in value, we tend to see the Aussie Yuan rate follow those prices higher. You could say there's a reason for the differential, the spread widening in recent months. China has been dealing with its own subset of concerns around Evergrande, around its property markets. The Australian dollar itself has been under a great deal of pressure because of the lockdowns in the Sydney area and the fact that they have not had access to a significant vaccine supply in recent weeks and months. But for the majority of the pandemic, up until we saw this divergence occur where China was seemingly weathering the storm that was the Delta variant, Australia deepening its Delta variant woes, oil prices as they rose tend to come at the disadvantage of the Chinese yuan, tend to be at the advantage of the Australian dollar here. So if you're looking at this, you could think about this in Aussie Yen terms as well. Unfortunately, I did not prepare that chart here for today, and in hindsight, I probably should have. But as oil prices have increased, Aussie Yen, that was trading higher too. So we want to be able to use FX as a proxy for what's happening in commodity markets. If you are a significant importer of oil and oil prices go up, that tends to be bad for your currency. If you're a significant exporter of oil and oil prices go up, that tends to be good for your currency. This is not a one-to-one relationship, however. And I think the correlation panel shows how over time, we've seen the positive correlation, while quite strong, near perfect, has eroded, has even flipped negative at various points in time. But the reason why we're saying that we want to use this as a heuristic, as a rule of thumb, is because over a multi-month period, over many years, these relationships tend to hold true. They're more of the rule than the exception. I did mention that while we were talking about everything that's going on in the commodity world, we wanted to touch on 2 different assets, oil being one, gold being the other. Gold prices, as you might have guessed from the table that we shared earlier in Australia, they tend to be correlated with the Australian dollar. While both Aussie dollar and gold dollar are quoted in dollar terms, and therefore when the dollar weakens, both Aussie and gold tend to rise, we see that Australia is actually the second largest producer of gold in the world. And so investors who are coming into these markets when gold prices rise or when they struggle, they tend to use the Australian dollar as a liquid proxy for this particular commodity. Again, why might you trade the Aussie dollar instead of gold directly? Well, gold doesn't offer a dividend, a coupon, a cash flow, but Aussie dollar offers an interest rate funding adjustment. And so in an environment where we've seen gold prices struggle recently, the orange line on our chart here, we've actually seen the Aussie dollar itself begin to weaken as well. There are, again, other factors that come into play, like during the pandemic itself, when Aussie dollar was rising alongside gold, the two were moving hand in hand. As gold prices began to weaken over the past of the course year, It's been one of those factors that have made it more difficult for the Australian dollar to continue to post gains. And of course, in recent months, the Australian dollar itself has shown signs of weakness. It's not just because of gold. Iron ore is a consideration there. What's been happening in crude oil moving sideways has been a consideration there. The fact that the economy is not recovering in the manner that many people had expected it to recover because of the Delta variant, that's also in consideration there. But the fact of the matter is that gold prices coming down have made for a much more difficult environment for the Australian dollar than one may otherwise assumed had they not been looking at this particular relationship at this moment in time. One pair that may come to mind as well, dollar Swiss. Now, we talk about dollar Swiss. Dollar Swiss tends to correlate negatively to the price of gold because the dollar is no longer the secondary quote currency here. It's actually the base currency here. Switzerland itself has about a little over 1,000 tons of gold reserves. And because of their banking sector, because of their financial system, they import and export a lot of gold. But you may not have known this. Each year, about 70% of the world's unrefined gold is actually refined in Switzerland. And so when we consider what's been happening in the dollar Swiss, the gold relationship, we actually see quite a little bit more of a sustainable price movement here, where the two go hand in hand. As we've seen gold prices go up, the Swiss franc was gaining in value last year, but over the past year, as gold prices have struggled, the Swiss franc has weakened alongside those gold prices. Again, a lot of this is common sense. A lot of this is basic macro fundamental understanding of the fact that if a country has a specific level of commodity exports, because that country will then be trading effectively, doing business with those commodity exports, the currency will be highly sensitive to what happens in that commodity price movement. We can see it a lot here. Unfortunately, the scope and scale of the gains were disparate, if you will, a little bit. But in general, the cadence of what was happening between the Swiss franc and gold prices, they moved hand in hand. When gold prices peaked at the start of this year, that represented the high point of the year for the Swiss franc. When we saw that gold prices cratered out in March and April, that represented a low point of the year for the Swiss franc. And as we came through the spring into the early summer months, gold's rise was met with a rebound in the Swiss franc. And more recently, the fall that we had seen in gold prices was related to weakness in the Swiss franc. I talk about the cadence here, the rhythm, the movement in price action, but not the scale, right? If you notice here, dollar Swiss, which is inverted for the sake of this chart, you can see here how, while it's only been about a 6.4% gain going back to the start of 2020, gold prices are up by 19.9%. Of course, when you're using leverage, obviously that has a different impact on your total returns. I just want to point out that we're talking about the general dance, if you will. They tend to move in very similar price patterns. When one experiences volatility, the other experiences volatility. When one goes up, the other tends to go up as well. There is one currency here that we have not yet touched on. And this is something that I find to be very interesting, very fascinating as it relates to central banks. And that's the Japanese yen. Now, just like dollar Swiss, which itself is negatively correlated with gold, if we're considering gold as XAU, USD, then dollar is the base currency in dollar yen. So it has a negative correlation with gold. But gold and yen have a unique relationship. And this is not necessarily because of commodity export levels, but it's because of the characteristics of the yen itself. I mentioned this before. Unlike stocks or bonds, gold does not have a dividend. It does not have a coupon. It does not have a cash flow. You're not going to get any money returned to you by simply sitting on gold. In the world of FX, there's this concept known as real rates. Real rates are your nominal bond yields. So if you were to go look at the US Treasury 10-year right now, you're looking at the nominal bond yield. The real rate is your nominal bond yield minus your inflation rate. Now, why do we care about that? Because for a currency like Japan, the Japanese yen, because of the BOJ, has seen a sustained period of low to negative interest rates. And when you adjust Japanese yen rates for inflation, you have deeply negative real rates. So if gold doesn't offer any sort of return, according to studies produced by various banks like JP Morgan, gold's cost of carry, in effect, its interest rate, is negative 2.4% per year over the past 30 years. And if the Japanese yen has the deepest negative real rates among the major FX currencies, historically speaking, then in the FX space, the yen's yield profile is actually most similar to that of gold. And so when we see the yen take on safe haven appeal because markets are reaching for liquidity, they're worried about lower growth, they're worried about some calamitous event coming out of Asia or in global financial markets, the same factors that would drive traders into gold also tend to drive those traders into the Japanese yen. Now you can see this over a multi-year time horizon. Instead of just looking back at what was happening during the pandemic era trading, I've since taken a chart looking at dollar yen versus gold going back to 2011. There's a specific reason for that because of what we're seeing here in the United States. Now, the pandemic era trading has not been kind. This relationship has broken down recently. But what was happening in 2011 that carried on through, say, through 2016? Well, you may be reminded of the fact that on August 5th, 2011, just over 10 years ago, we saw the US lose its AAA credit rating. The US saw its AAA credit rating slashed by Standard & Poor's, and Fitch and Moody's, while declining to do so, they warned that further episodes of, in effect, games of chicken over the full faith and credit of the United States could lead to further debt downgrades. Well, it's now September 2021, and the US is now back in the position of exhausting emergency measures to keep the country running. If Congress and the White House do not come together over the next several weeks and sign a new debt deal, the United States could very well be looking at a breach of its debt ceiling, which of course would mean a technical default. What's also happening right now as we're coming out of this pandemic crisis? We're starting to have conversation about the Federal Reserve normalizing policy. What occurred in 2013 and 2014? We had our taper tantrum. We had the market reacting sourly to the idea that the Federal Reserve would be winding down its global financial crisis era stimulus efforts. And all of a sudden, here we are today, this Tuesday, September 21st, talking now as the Federal Reserve itself has just begun its two-day meeting that will conclude tomorrow with the press conference and statement release at 2 p.m. Eastern, in which it's widely expected that they will begin to signal that the taper is about to arrive. So history often doesn't repeat, but it certainly rhymes. And from my perspective, it appears that we're looking into a period where it very well may be rhyming with what we saw in that 2011 to 2016 window, where we had problems over US federal government spending, where we had threats and concerns about the US credit rating, where we had a Federal Reserve, all while this was happening, talking about tapering down its stimulus measures. And you know what? During that period of time, we saw gold, we saw the Japanese yen, they tended to trade hand in hand. We tended to see a very strong relationship play out over several months, several years, in which when yen weakened, gold weakened, when the yen strengthened, gold strengthened. Some of this has been coming undone over the past year plus, thanks in part to what's happened around the pandemic. But it's possible that we may now be returning to a moment in time like we had 10 years ago, where yen and gold, not just because of their yield characteristics, but because of what's happening in the world around them, begin to trade in lockstep once more. So to briefly summarize what's been going on here today, and I do see that we have some questions that have come in, and this session runs for another 6+ minutes, so we can get to perhaps a few of them, Todd. I do want to just briefly catch on to the overall point of what we were talking about here. I'll say it for a 5th time. In the short run, higher commodity prices lead to an increased supply of foreign exchange in the markets of commodity exporters as the result of increased export revenues, which tends to cause an appreciation of the domestic currency. Over the medium to long term, this effect might be then compounded by ensuing foreign direct investment as a result of more attractive investment prospects in the local commodity sector. So when oil prices go up, those countries that tend to export a lot of oil, they tend to see their currencies gain in value. And the flip side is also true. When we see countries that import a lot of commodities, when those commodity prices go up, their currencies tend to weaken. You're talking about the Chinese yuan, you're talking about the Japanese yen. Countries that import a lot of oil, their currencies actually tend to struggle during periods in which oil prices rise. But when oil prices are rising, countries like Australia, like Canada, they tend to see a benefit for their currency. Same thing for the Russian ruble. Same thing for those Nordic currencies, which are, of course, between the North Sea and the Arctic, they tend to export a lot of oil. So you can look beyond the simple commodity markets themselves. You can look into FX, which again presents the benefit of the overnight interest rate adjustment in order to gain exposure to these various happenings in the commodity market without necessarily taking on direct commodity exposure itself. And a reminder, FX is the world's deepest, most liquid market. It's open 24/5. You're talking about over $6 trillion in flow every single day, according to the Bank of International Settlements' recent triennial survey. That is more liquidity. You find more liquidity in a day of FX markets than you do in many stock exchanges around the world over the course of an entire year. So what's happening in FX, it's very sensitive to what's happening in the rest of the world, and it tends to be a deeper, more liquid market than you will find literally anywhere else on the planet. And so for those that tuned in for this entire session, I want to just say thank you, of course. My name is Christopher Vecchio, if you didn't catch that at the beginning, a senior strategist here with DailyFX. What do we do with DailyFX? Well, we are a subsidiary of IG, a sister company of Nadex. We provide research, news analysis. We highlight important fundamental technical items along with implications for markets to help you as a trader make better decisions. At the end of the day, that's really what we're here for, to help give you education and information that will make you a more informed trader. We have live webinars where we share our real-time analysis on what's happening in the market. Of course, tomorrow with the Federal Reserve meeting, you can find me on dailyfx.com/webinars for a live coverage of the Federal Reserve meeting. It will also be up on the front page of dailyfx.com starting at 1:45 Eastern, that's 13:45, or 17:45 GMT, depending upon where you are in the world. We'll talk through the Fed meeting, what it means for the US dollar, what it means for gold and oil and US stocks, and we'll get you prepared for what Fed Chair Powell may say at the bottom of the hour when he goes to the podium for his press conference. Of course, beyond live sessions, you can also find us producing other content like weekly forecasts, and other forms of media, like the Nadex sponsored macro setup, which is now live for this week. I was able to record that earlier today with Guy Adami and Dan Nathan from CNBC. Highly encourage you to check that out as well. Available wherever you get your podcasts too. And so if you want to follow us there, you can always do so for my personal Twitter handle at CVecchioFX, that's CVECCHIOFX, or the DailyFX team at DailyFX team. Todd, if there are any questions here, I'd be happy to answer them now.
Yeah, we do have one question that I think really needs to be answered, and I think it'll help connect the dots between the trading opportunities. And someone had asked, we know that there's this relationship between the commodity prices and then the currency, and it sounds as though, if gold moves, then you might see something happen with the Australian dollar. If oil moves, you might see something happen with the Canadian dollar. How quickly is that information digested into the marketplace? So if you're looking for trading opportunities and you see, for instance, gold going haywire, how quickly will you see that potentially impact some of these FX pairs? So, I mean, how is that opportunity play out when you're actually looking for potential trading opportunities?
That's a great question. It's actually both in the very short term and over that longer term time horizon, Todd. And thank you for whoever who asked that question. If we do see gold prices take a significant dip on any given day, there's also a typical contemporaneous reaction in, say, a weaker Japanese yen or a weaker Swiss franc, a weaker Australian dollar. But one thing that happens over time is that when commodity prices tend to stay elevated or depressed for a prolonged period of time, it actually can increase the amount of speculation around those associated currencies. So when you have an event, as I believe Brian Caprice was sharing earlier, when you have economic data or news that comes out, you see the reaction domino across asset classes. If it's bad for oil, it's bad for the Canadian dollar, bad for the Russian ruble, and those things tend to be instantaneous. But if oil prices don't recover, it can actually lead to FX markets extending their losses deeper than that. Why? Because you don't see foreign direct investment come in play. You don't see higher levels of a given currency in circulation as a result of, say, exchanges needed to pay the bills. If oil prices come down and stay down for a while, the Canadian dollar can tend to suffer for a prolonged period of time because US importers won't need to exchange their dollars into Canadian dollars at the same rates. So reactions tend to be instantaneous, and they happen to stick for prolonged periods of time. I myself am a longer term swing trader, and so when I look at something like what's happening in iron ore right now or with gold, it doesn't lead me to believe that there's going to be significant demand for the Australian dollar moving forward. And so even if there is a little bit of a disconnect and the Australian dollar tends to rise on some unrelated news event that doesn't impact gold prices, it presents to me an opportunity where I may say, I could get short the Australian dollar here because I see that the commodities that they export are not recovering in value, and therefore demand for the Australian dollar moving forward in the future will be lower.